All right. So as the day just gets underway locally, let's check in with James Gerrish from Shaw and Partners and lead portfolio manager at Market Matters. James, very good to see you there. So it was a bit of a mixed session on Wall Street overnight. How would you view what's going on? I mean, particularly there, I guess. And I was mentioning the S&P 500 now at a two-year low.
Yeah, good morning to you, Andrew. It was a bit of a mixed session over in the US last night. So when our market closed yesterday, US futures were up about 1%. They obviously had a reasonable start to the session, but then tapered off late to close marginally lower on the S&P 500. But the Nasdaq was actually higher, and that's a theme we've started to see. So tech stocks have been absolutely belted over the past 12 months. Our tech index is down 40%. So we're starting to see some investors starting to pick through the rubble in there, and I think that's probably got legs in the short term.
Yeah, well, I mean, let's stick with tech then. What your outlook is for that, whether you're seeing some good value there, particularly some big tech in the States, bearing in mind, I was just mentioning those bond yields where they're heading at the moment, and more broadly as far as what central banks are doing, they're only going to go higher from here, and that obviously hits those growth stocks.
Yeah, absolutely. I mean, that's a debatable topic, I guess, Andrew, whether or not bond yields continue to appreciate from here. There's a lot of tightening of financial conditions already priced into the bond market. So, in terms of where futures are implying interest rates will be, they're going to peak, which is priced into the market midway through next year, around 4.5% over in the US. So, as you may mention of earlier, bond yields have been on a really strong move higher. I think the market is particularly come with what's happened in the UK. The market is positioned very much for higher interest rates. I think that's a known. I wouldn't be surprised if we started to see some tapering off in terms of bond yields, and that is what's going to play out and see tech trade higher in the short term. So I guess that's our positioning at this stage, and we've started to see it the last couple of sessions where tech has outperformed, as I said before.
All right, so are you looking to pick up stocks there, or how do you view tech locally?
Yeah, I mean the last couple of things we've done in our growth portfolios is adding to Seek, adding to REA Group. We've started a small position, so started accumulating Megaport in the last couple of days. Over in the US market, last night we bought into the Disney. So, just adding incremental exposures into these technology stocks that have been hit very hard. I mean, things like Megaport are down, down from significant levels down to 52-week lows or thereabout. So, adding those incrementally, Andrew.
James, how are you feeling about resources at the moment, those stocks? Given commodity prices have tumbled recently, obviously that's impacted a lot of those stocks. Are you seeing some opportunity right now?
Yeah, so if you think about what's playing out in bond markets, so bond yields have continued to be strong, but we've seen a pretty decent pullback in the resources space. That's as sort of recessionary fears come into to force. So if the market moves from concern about inflation to concern about looming recession, then it's understandable that you're seeing commodity stocks under pressure, and that's what we've seen. So I think that theme will continue in terms of commodities underperforming the likes of tech in the short term. But I think you know, another 4 to 5% downside in that space will look appealing. So we're not shunning the commodity complex at the moment. I think there's starting to be value emerging in that space, but it comes down to what the market's interpretation of recession is and the like. So if I look at something like Sandfire and Oz Minerals, for example. I mean, Oz Minerals is under takeover from BHP. Sandfire is down 20 odd percent from the date of when that bid was launched, so around the 8th of August. So I think there's some relative value creeping into some parts of the resources trade there, that being an example.
James, we got some retail sales figures coming to us today. What's your expectation there, and how are you feeling about retailers at the moment, with the prospect, obviously, of those rising rates and just how consumers are likely to respond?
Yeah, I mean, so far, so in terms of today's retail sales print, it's looking to be plus 0.4% month on month. But more broadly in the retail space, obviously, some parts have been doing better than others. So, we've got holdings in Lovisa, for instance, which has been doing particularly well. But some of the more rate sensitive, areas of the retail space that are more susceptible to consumers with mortgages and experiencing the increased cost of living and the like are doing it tough. So we don't have large weightings in terms of consumer discretionary stocks. We've got some Metcash in our income portfolio. We've got some Wesfarmers in there as well, but we have nothing in our growth orientated portfolio. So I think there's we're starting to see some value emerge in that space. Super retail would be something I'd highlight as a consumer discretionary stock that's on our radar that we don't own yet. But yeah, look, I wouldn't be as bearish as the market is implying at this point in time.
Yet, I mean, you talk about those opportunities then that are available. Anything you're looking to offload at the moment?
Yeah, I think you've got to be nimble in your portfolio. So some of the stocks that have been disappointing coming out of reporting, I think is you've got to have your best ideas in the portfolio, and it's been a tough time in market. So there's some underperformers across portfolios that we would use as funding vehicles. So at this point in time, we haven't needed to because we've been carrying reasonable cash levels. So we've used this market weakness to add positions into portfolios. But now we're pretty much fully invested. We'll need to consider what stocks to sell. So probably our weakest link in our growth orientated portfolio in the last couple of months has been TPG. They reported some pretty weak numbers and muted outlook, but they didn't provide financial metrics in terms of the outlook. So that would be one we'd look to jettison. But again, the resource stocks are at or near lows. We think the technology stocks, I think, are at or near lows. So it's harder to find stocks to sell when the market's trading at such depressed levels, Andrew.